right, well, week 5 presentation of GK Lodge, all about money matters and considering financing options. We went through and created a pro forma spreadsheet. I created an income statement, which could double as a cash flow statement, a payback period calculation, and a net present value calculation. The income statement dictates that we can be profitable in the first year. I had extremely conservative estimates using industry averages and a growth rate in sales that actually slows down over the years. It starts at 8% and goes all the way down to 1%. And using industry averages, I was able, and what they're charging now for rooms, I was able to come up with sales numbers as well as expenses, and after calculating all the taxes, I was able to get the net income. The payback period was determined to be between 5 and 6 years, probably closer to the end of the 6th year. We'll be able to pay back all of the original investment, including the mortgage, interest, and renovations done in the facility. And this is without moving any of the income at the end of the year into retained earnings. So after doing that, I did a net present value calculation where I took all the cash flows from all the years, put them with the initial investment and a discounted rate, so a cost of capital of 10%, and I got a positive value dictating that the project is worth it and is a value-adding project to us.
So then we move a little bit to some financing options. We kind of came up with 2 main options. Our first one is going to be equity financing, probably our primary source of funding, and then our second one is commercial real estate loans as our second option. So we'll start with the second option, commercial real estate loans. Some of the pros for that for us would be that we'd start with a long-term repayment period. So we'd probably pay off these commercial real estate loans in 10 years or so. And this will boost our overall cash flow, which is obviously key for us. And little fact was 82% of small businesses in the US fail due to cash flow issues with the mismanagement of funds. This will also provide us with a large amount of funding, as it is more accessible than other funding options. It does have some cons though. So typically higher interest rates would be involved with commercial real estate loans. It's more of an extensive application process to kind of get into it. And then it's a difficult task. It's got stringent eligibility requirements, as meeting the lender's eligibility criteria is a difficult task. And then it also has a lack of repayment flexibility with it does have extended repayment loans, but the terms are somewhat rigid with commercial real estate loans. And then equity financing, which was our first option. So there's 2 methods of equity financing, obviously private placement of stock with investors, and then these public stock offerings. So this method is kind of key for us because we're going to be in dire need of cash right away. And then this equity financing is going to be through individual investors, which is probably people that we're connecting with here at college, or even out in Montana, make connections out there. We'll also have angel investors, venture capitalists, and then IPOs or crowdfunding as well. So those are kind of more about the 2 financing options, and that's about all we got.
Thank you.